by GovEx Uranium.
After a week in Colorado focusing on the gold market, we're back focusing on the uranium side of things. I'm joined with the uranium insider himself, Justin Huhn. Justin, good to be with you.
Great to be here, Peter. Thanks for having me.
What were your main takeaways from, obviously WNA was just about 2 weeks ago now. Have you had a chance to sort of collect your thoughts and look through your notes and sort of see what the key themes and takeaways were?
Yeah, I think the key themes and takeaways were pretty clear during the conference because the same topics kept coming up in every single conversation. A lot of discussion around potential M&A, a large M&A in the uranium space, whether or not that will happen, on what time frame, what that looks like. A lot of discussion there, especially with the big greenfield projects in the Athabasca Basin.
Yep.
There was a lot of discussion around utility action or lack thereof, where the utilities are at now. We're starting to hear essentially that a few large utilities in the United States that are more well covered for their near and midterm needs are starting to kind of advocate for the industry and reach out to other utilities, sort of trying to prod them to step up to the table and sign these higher price contracts with the legacy producers. And there's still some headbutting going on there between the utilities and the producers, but we can dig into that more. But that was certainly a theme. The vibe of the conference was very high. I would say everybody in the industry is kind of bullish. So that's to say the nuclear, the nuclear producers, the actual builders of nuclear reactors, like they're in a renaissance right now, and they're operating in an environment with way higher prices and demand for electricity like they never expected to see. So that's all great. Then we have the finance side of things, the investors on the uranium side, also very bullish for what's coming ahead of us. And lastly, I would say that one of the themes that I took away was that it feels like the time for uranium is coming. So the last 2 to 3 years, the focus has really been on enrichment conversion, especially with the disruptions out of Russia. So that, and a lot of utilities secured a lot of conversion and enrichment and have yet to cover their uranium feedstock needs for those contracts. So it does feel like there's a renewed focus on uranium itself. And right now, there's still some big unfulfilled RFPs in the market right now, and we're expecting more utilities to come to the table relatively soon here.
Yeah, I went into this conference, not really, I wouldn't say that much of an expert on uranium, but I feel like I got baptized in a way when I was there. I came out a pretty big uranium ball.
It's a good place to do it. Yeah.
Yeah. Look, we had loads of really interesting chats with Cameco, with Ocean Wall, with Peryander, with the SPUT guys, and everything we were hearing sort of echoes what you were just saying there. It's a really, really exciting time in uranium, and it seems like we are now transitioning into it being sort of uranium's time, rather than just the enrichment side. One of the key things that I think it was guys at Ocean Wall were telling us was that the Kazakhs have essentially holding guidance for 2026. They've reduced their production profile by about 10%. They're even saying they might do 20% less the next year as well. You've obviously got Cameco also sort of butting heads with the utility companies. That's 60% of the world supplying those two companies, almost in a coalition together, basically saying your move, utilities. How do you see this playing out? I got the impression that within the next 12 months, something's going to have to happen.
Yeah, same here. That's kind of where everybody's at. Leaving the conference, I would say most people don't really have super strong convictions on what's going to happen next week or even next month, but that we're getting very, very close to an inflection point for utilities, and we're going to see a move within that time frame for sure. Yeah, the Kazatomprom and Cameco, those were two pretty big news stories that came through in the weeks leading up to WNA, which I thought was quite interesting. Cameco saying that they're moving into a new zone from McArthur River, having a little bit of struggles with skilled labor, having some trouble getting that up to that nameplate 18 million that we've been expecting on an annual basis from that mine that's been producing around that period, around that capacity for many, many years, with the exception of the voluntary putting into care and maintenance in the late 2010s. But they're saying 3 to 4 million pounds short on McArthur for 2025. And potentially Cigar, they can squeeze a little bit more out of Cigar to ease that loss. But that's something that utilities and everybody really should take note of, especially on the skilled labor shortage. If Cameco is such a legacy operator in that area and having trouble attracting that talent, it probably speaks volumes to the greenfield development projects that have yet to start producing, or yet to start even building the mines. And there's a couple of those in the Athabasca that that the industry and utilities are expecting to be producing in the coming years, and are actually crucial to be producing in the coming years. So any disruption there, I think, is going to have a meaningful impact on the market. As far as going forward for 2026, Cameco likely is going to be able to figure it out. I don't think this is going to be ongoing problems at MacArthur, but they do have, the asset of Cigar Lake, which is going to be essentially done producing in the middle of the next decade. So that's something for their pipeline, as well as Orano's pipeline, that's worth keeping an eye on. They're going to have to replace those pounds at some point. Kazatomprom, a little bit more nuanced. They've got an interesting situation where they're still majority state owned, but they're public facing part of the company. I would say that they are operating with as much responsibility to public shareholders and the uranium market and the uranium price as they can. They are guiding down for their 2026 production, in that they're reducing the 100% of subsoil use levels. So if they were to produce at 100% of that subsoil use contracts for all of their projects on a 100% basis, which is their 100% owned projects as well as their joint ventures, that has been reduced significantly for 2026. Although they have not yet given official 2026 guidance yet, but they did say they intend to utilize their ability to flex production below those subsoil use levels up to 20% below. I don't think they're going to go 20% below across the board, because that means they're going to be producing millions of pounds less than we're expecting for this year, which is not what we're expecting. They also have joint ventures with a number of state-owned entities that are pushing to increase production. So they're trying to balance this and walk this fine line. The Chinese, the Russians especially, are their number one JV partner, and the Russians have a lot of enrichment, a lot of conversion. They're basically short uranium. So the Russians need as much as they can get out of the country. The Chinese need as much as they can get out of the country. Then you've got Kazatomprom themselves, which is saying, we're not seeing what we'd like to see from utilities in terms of demand and them stepping up in the market. We're going to execute some diligence here, and not going to, rip pounds out of the ground in a major way until we see that. And of course, if you just do the basic math on what is needed on the sulfuric acid in terms of ramping production, especially with their development projects like Budenovskoye, it's going to take significantly more acid than they can access right now to have a meaningful jump in production. So they expect the new acid plant to be operational the early part of 27, which means in our models, we're modeling for a larger jump in production out of Kazakhstan in 2028. But that jump is so short-lived, and you can actually see that graphed out on their investor handout. They basically ramp to peak production relatively quickly. Theoretically, it peaks out and immediately falls. They've got a bunch of legacy projects, 100% owned and JV, that start to decline late decade, and you get into the early mid-2030s, their production, regardless of how much acid they have access to, et cetera, unless they have drastic expansion into exploration projects and new developments, we're going to see a decline in production out of Kazakhstan, which is new because they've essentially only been growing production since they've started producing back in the early 2000s.
Yeah, that was one of the curious things. I especially with Cigar Lake obviously going offline mid 2030s, and then you also then compound that with a lot of the Kazakhstan production falling off a cliff towards the end of this decade. You marry that up with the fact that there is no real investment in development projects at the moment until this utilities fight has been sorted. It seems like the longer this goes on, I guess the longer and the worse the potential supply shortfall could be, couldn't it?
That's absolutely the case, and that's one of the reasons why you have actually some utilities starting to tell other utilities that you guys got to step up here, because we're going to have a problem in 5, 6, 7 years, and that 100% could be the case. And unfortunately, whether or not that's the case is extremely contingent on a couple of large projects, and one in particular, which is NextGen's Arrow. And whether or not that is producing on time, on budget, is going to have a huge impact on this market. So I think to say that nothing's being developed is incorrect. You have state-owned entities doing absolutely everything that they can to increase production. And production is increasing. It's just not increasing in line with demand by any stretch of the imagination. So the demand projections going out, let's say 6 or 7 years from now, are pretty easy to model. You know what's operating. You can make pretty well-educated guesses on what's going to be life extended in that time frame. We know what's under construction now and can make educated guesses on when those under construction plants will be operational, and especially in places like China, basically 5.5 years from first construction start, they're hitting the grid. And so you can actually model that demand pretty easily, and then to compare that to the supply picture is pretty shocking. And those big projects are 100% necessary because there just isn't any sort of windfall of secondary supply or inventory that we can see coming into the market. Could things happen at a much higher price? That's entirely possible. But as the price has gone from $18 all the way to 106, back down here where it's 76 spot, 80 term, we have not seen supply respond in a meaningful way to that gigantic move in price. Now, if we get up to 150 and it stays there for 5 years, are we going to see a lot of projects built? Of course we are. But we're many years away from that happening, and we need utility demand to push the price that high. Yes, financialization is there and could happen in a much larger way going forward. That is entirely possible, but you have to have a basic supply and demand model based on utility demand. That's the foundation of this trade. But these right tail secondary demand possibilities are all there. Strategic sovereign stockpiling, like the US just announced a few days ago, is coming. Any sort of inventory restocking beyond that replacement rate demand, and the financialization, all of those things are basically there and have potential to be much, much greater in the years to come. So we'll see.
Yeah, one of the things that I couldn't really get that much information on, which I was fascinated by at the conference, and this again, the opaque nature of this industry was the amount of stockpiles and the amount of mobile inventory still available in the market. Have you ever been able to get a sense of how long utilities have left until these stockpiles are looking a bit too low for their comfort?
So the inventories, to speak generally, have basically been maintained. They've dropped a little bit going back, 5, 6, 7 years in that type of time frame. But the last few years, they've been able to maintain inventories. There hasn't been a whole lot of inventory growth, nor necessarily drastic and concerning drawdowns. And the utilities have been able to do that basically by flexing up on legacy contracts when they're delivered. These contracts that were signed late 2010s, early 2020s that had sometimes up to 30% or even greater quantity flexibilities. And the utilities have been able to flex up on those contracts. And that has allowed them to kick the can down the road on signing big new contracts with Cameco, Orano, Uranium 1, Kazatomprom. But it's also tightened the near and the midterm. And this is why if you want to sign a multi-million-pound contract with delivery starting in like 27, 28, you're going to have a very, very hard time doing that. And the Koreans are experiencing that right now with a large RFP in the market that's still gone no bid. So that the midterm is very tight because of that flexing up, but it has allowed the utilities to continue to maintain inventories. They bought a little bit of EUP here and there. They've been able to do a little bit of strategic borrowing, and they're buying in the spot market this year in greater volume than they have in recent years. And so that's something that they're doing. If you pick up the phone and you want to call Cameco and say, okay, we're looking at 2 million pounds a year, 28 to 33, what do you got? And they say, we want $85 floors, $115 ceilings, 80% reference to the market or 100% reference to the market, and you're a fuel buyer and you look at spot at $76, you're going to go and buy spot at $76. And there's only so much liquidity there, so it's not a long-term great solution. But we have seen, way more uranium has been purchased by utilities in the spot market this year to date, even going back a month ago, than the entire year for 24. So there's been a lot more spot market purchasing, buying EUP, and flexing on contracts. That's allowed them to stay sort of in stasis in terms of contracting. But all of those flex options, they dwindle and they go away in the coming years, and they drop off pretty steeply going forward here. So they are going to have to come back to the table. As far as above ground mobile inventories, our understanding of that is extremely minimal. You basically have whatever is held by the hedge funds, which is maybe 15 million pounds is a very rough number, held by hedge funds that could be sold into the market. The pounds that are held by SPUT are not coming into the market unless SPUT is literally taken out, which is a whole can of worms we can get into if you want to, but that's something to be devoutly wished, because the market conditions that will result in that happening we're very happy campers by the time we see that. So
Yeah.
total global inventories are very large. The Chinese will never sell any of their inventories. That's not for sale. It never will be for sale. Mobile inventories that are above ground and available in the open market are extremely minimal, especially when you compare those to even the annual replacement rates of demand.
Welcome to GoVX's Montanga uranium project. It is right next to the Kariba Dam, a 4-hour drive from Zambia's capital, Lusaka. It has great infrastructure, benefiting from road access and proximity to power lines. Zambia is a pro-mining country, and we have the support of the government for our project, which is going to be Zambia's first uranium mine. Our Montanga project is already mine permitted, and it is a simple open pit heap leach operation.
The feasibility study is complete, and we have filed the ESIA and relocation plan. GoVX has recently announced a reverse takeover of Tomador Iron, which will result in an Australian listing, a new name, Atomic Eagle, a strengthened balance sheet and corporate structure in a market that knows Africa, supported by a proven uranium team.
You mentioned something there around SPUT. I wouldn't mind actually talking about that. Obviously, they've got around, what, 70 million pounds of uranium now in vaults. Something I hadn't even thought about. You just mentioned that they could be taken out at some point, and I assume that would then open up that 70 million pounds to the market. What sort of markets, what sort of scenery would we need to see something like that happen?
So this is a really, really interesting thought exercise. The utilities are nowhere near considering something like this right now. So that's important to be said. In order for SPUT to be taken out, it would require a 2/3 shareholder yes vote. That is to say, not 2/3 of the shareholders that choose to vote yes. 2/3 of their entire shareholder base would have to vote yes. Okay. And you would have to consider the implications of that yes vote, which is, all their uranium becomes available to whoever is taking them out, whether that's a consortium of utilities or it's a sovereign. I don't really know. I don't know that it's going to happen, but these are the conditions that would allow it to happen. That would have to be a big enough premium for those shareholders to vote yes, for them to accept the consequences of that vote. That also, if you would consider, let's just say we're at $150 uranium, and which I think is coming, by the way. We're at that level. Utilities are panicking. They make a bid for SPUT, which, by the way, at $150 uranium, all other things being equal, that basically doubles their NAV at this point. So now we're talking, what are they going to be at let's say a 12 billion NAV? So the premium that'll be offered would have to be how much for the unit holders to vote yes, 2/3? 30%?
Yeah.
50%? I mean, whatever it is, we're talking 15 to 20 billion offer to take them out. That also immediately implies a 30 to plus % premium on the actual printed spot price in the market, because you're telling the market this is what uranium is worth. So it's a statement as to the I mean, it would absolutely set the sector on fire if that were to happen. And I don't know that it ever happens, but that's what would have to happen, is that 2/3 yes vote. The premium would have to be good enough to get all of the 2/3 of the shareholders to vote for it, understanding the implications of that uranium coming. It wouldn't come into the market. Nobody is probably going to do that and then sell that uranium. That's probably a sovereign or a consortium of utilities or something like that. But I think we're a very long ways away from that. Most utilities still are not concerned at all, despite the fact that the price of uranium has quadrupled and the price across the fuel cycle has tripled over the past few years. That they still are not concerned. They see the warnings from the WNA, and now we actually have these unbiased entities sort of warning the industry, like the IAEA was involved in one of these conversations in the working groups leading up to producing the fuel report. And there was a comment from somebody from the Red Book, and the Red Book that's put out on an annual basis that it looks at total global resources. Basically, the Red Book representative said there's plenty of uranium, it's not a problem. And somebody from the IAEA, the International Atomic Energy Agency, which doesn't really give a damn about the uranium price. They're looking at the global nuclear picture, and they're generally nuclear advocates for the industry. But this person from the IAEA said, yeah, there's a lot of uranium in the ground, but if we don't spend the money right now, an enormous amount of capital to expand production and supply, there's going to be a major, major problem. We have to do it now and in a big way if there's even a hope to find a balanced market in the 2030s. And that's coming from the absolutely unbiased IAEA. And a rep from the WNA during the session where they unveiled the fuel report Same thing, big warnings to the industry. We've got a supply problem here. And of course, you have a representative from one of the big state-owned nuclear operators basically saying, look, producers, please go easy on us on price in these contracts, which everybody thought was kind of funny. Had a good little chuckle about that.
Yeah.
But, so yeah, it's an interesting point right here.
Okay, but so it seems as though, although it's quite unlikely, especially in this decade, if we do see this lack of investment carry on for another year or two, it may well be that there's a scenario where there generally is not enough supply, and maybe that dipping into the SPUT vault might be one of the only options down the line.
It's not a 0% possibility. Yeah.
Yeah. Well, just staying on SPUT and moving more onto the spot market, this was something that I found really interesting about the uranium market, is how you've got a 30 million pound market, which is the spot market, 30% of which might be, utilities, but the majority of it is sort of traders sloshing around the same inventory, and then you sort of have that market which is then having an impact on the negotiations of the long-term contracts. And for me, it was just a bit of an insane idea that you could have such a small market with small liquidity that can clearly, I wouldn't say manipulated, but can clearly have big impact in terms of the trading that's going on, then have an impact and have utilities or whoever say, well, look at the spot market, this is why we've got to do a lower price. It blew my mind almost. I don't know. Do you foresee the spot market continuing to have an influence on negotiation pricing?
I'm sure. Yeah, it always has an influence, but it has an influence to a certain point. I mean, first of all, I should say that a lot of the market reference contracts that are to be priced at the time of delivery based on the market price, which is to say the spot price usually. Sometimes it can be a blend of the spot and the term price. Most of the time, it's a multi-month average of the spot price leading up to that delivery. So 3 months or 6 months spot average. So rather than the actual spot price on the day of delivery, which is open for enormous potential for manipulation, it's usually a multi-month average to kind of take care of that possible problem. As far as spot influencing negotiations, it does and it doesn't. So if you're a utility right now, and again, to bring up Cameco, primarily because they're the biggest Western producer and they're the biggest publicly traded, uranium producer. If you call up Cameco right now and say, hey guys, spot 76 right now, how about we sign a long-term contract right around, 76 base escalated, they're just going to laugh at you. And so they know that the spot price is not the real market when we're talking about large volumes procured for future delivery, which is really the real uranium market. Even though the spot price is what everybody sees because it has daily updates and there's some liquidity there, there's some volume traded, like you said, most of it's back and forth. This year it's a little bit different, more utility procurement, but generally speaking, that's a true statement. It isn't having a huge amount of influence on the big boys signing the big contracts.
Okay.
It does have some more influence on, that is to say that where the market price is right now on base escalated contracts that have been signed in lower volumes by developing companies. And that's one more element that's kept the price sort of where it is when there's not huge demand coming from utilities in the term market, smaller multi-100,000 for a few years delivery, they'll call up, the Bosses of the world, the Auras of the world, the Lotuses of the world that are developing smaller assets and be able to sign these contracts because there's more risk with those projects. They'll get better terms. But when we're talking about big volume, long-term contracts, which we yet to really see this year being signed at all by any utilities, that's when they have to step up to the larger producers, and that's when they are going to have to sign at the terms that they want. And we can go down that road in that discussion if you want to. But just briefly, I did a long-form post on X about a week and a half ago where I discussed kind of the elements that are influencing the current pricing metrics that these big producers are wanting. And from a utilities perspective, it looks vengeful, right? They went through hell in the last decade, and now the spot's at 76, terms at 80, and you're telling me you want $150 ceilings. I look at your feasibility studies. I know what your operating costs are. I can read your financials. You guys are trying to put the screws to me. But you have to look at, we just went through an extremely difficult period for our shareholders and for us with very, very, very low prices. And at that time, you all could not care less about us, and you were happy to buy from the Kazakhs and the Russians and the Japanese selling inventory and leave us, to starve in the desert.
Yeah.
Now, not only do we have to make up for that period of time in some ways, the sunk capital that has gone into building these projects, maintaining our employee count, maintaining these projects over the years, even when the demand wasn't there, $10 million a month for care and maintenance on MacArthur River. Then we get into the future, and you can look at the pipelines for Cameco and Orano. And Cameco will tell you the pipeline is fine, and it is for the time being, but they have only so much on their tier 1 production. They've got a decent amount of tier 2. Orano has a major pipeline problem right now. So, and that's their big joint venture partners with both of their producing assets. So we get into that, and you start to see these companies need to cover these sunk costs, cover their actual cost of production right now, and build capital to produce into the future in an unknown market. What will the price be 10 years from now? How bad will inflation be from now and then? What will we have access to enough skilled employees at that time? All of these things are valid questions, in addition to building out the next resources that will equal production for these companies in the 2030s, 2040s, 2050s, and beyond. All of that has to be considered into these long-term contracts. And I think that's a message for the utilities is Cameco, Orano, Kazatomprom, they're not turning the screws to you. They're making sure, especially Cameco and Kazatomprom, taking care of their shareholders and looking out into their future pipeline for production. And that has to be considered in these contracts, not just their all-in sustaining cost of production.
Yeah, no, well said. I think that's spot on. Even just looking at the junior side of things, it seems like their access to capital is really delayed up until we start seeing these contracts on their end as well. So it's not as if we can even have any new greenfield projects sort of come back online. What do you think we need to see? Do we need to see the likes of Cameco and the likes of Urano sort of start doing these long-term contracts with big demands, big orders over a long period of time, and then sort of confidence can then start trickling down into the juniors and developers? Because it seems like they're not really being taken seriously by the utilities yet at all.
Oh yeah, I mean, I think the juniors are not being taken seriously by anybody right now. They've been completely forgotten by investors and utilities. I mean, to some extent, the utilities have paid more attention to the smaller developers because they've been willing to sign smaller volume contracts at the terms that they like because of that production risk. But that's not going to be able to satisfy all of their demand, and it's not going to be able to satisfy their risk management. They cannot they cannot procure all of their uranium needs from one source, even if that source is Cameco. They have to spread it out, right? So yes, that's absolutely the case. I think what's going to kick things off, not only for juniors, let's say small and mid cap explorer and developer companies on the equity side of things, but also for the price of uranium, is going to be a number of large utilities coming to market and signing these higher price contracts. And that's going to trickle out. There's a lot. I mean, there's a few utilities that are extremely sharp, that are very well covered, that have their own supply and demand modeling, that historically have been more aligned, let's say, with investors. And the investors are, by nature, looking out for their own bottom line and trying to predict what's going to happen in the future. Utilities have no incentive to predict the future. They really don't. And strangely enough to say, for their entire careers, there's been an enormous, abundant supply of relatively cheap uranium, with a tiny exception, which was 04 to 07, which they will blame on Uranium Participation Corporation and the hedge funds. That the price went to $134 because of financialization over the course of a couple of years in a raging commodities bull market. Besides that blip on the screen, for the last 40 years, it's been abundant cheap uranium. So their bias is still, this too shall pass, and we're going to do what we can to procure cheaply as long as we can. They're not concerned. The depth of their research on the market is reading UX Weekly, which is UXC's weekly product. It's very good, by the way. But they also are not in the business of predicting the future. They report on what's happening right now in the market. And if you read at any given week what's happening right now this week in the market, 99% of the time it's not panic, my hair's on fire. It's this much was traded here, this much was traded there, the price is going up, the price is going down. And that's what they see on a weekly basis. So most utilities aren't concerned or trying to predict the future, but most of those same utilities, they wake up when Constellation or Duke or Dominion signs a 4 or 5 million pounds for delivery, 10-year period. That's a huge contract. When that gets done, and it will, that wakes up the whole sector. And that also is going to have a meaningful impact on price. And we've already been through a period of stagnation, which is why we think we're very close to a price move. Spot's been stagnant for a while here. The long-term price has been within a $2 or $3 trading range for a year and a half. That's a very long period of consolidation. So both of those are set to move higher. And even the quote unquote unbiased industry price reporters like UXC, like Trade Tech, they're kind of waving the warning flags. Last point on this, and sorry to ramble on too long, but I think it's important to make. UXC historically has been relatively conservative in terms of their forecasting. They use conservative metrics in their supply and demand models. They printed an article about a month ago now that basically was saying the long-term printed price indicator is not telling the whole story. Most of the demand in terms of conversations between utilities and the large producers is happening off market, and we're looking at market referenced contracts, not fixed price contracts, with much, much, much higher ceilings than where the market's at right now. So they basically, in many ways, just said, we're headed higher, guys. And they're communicating to their base, which is utilities. That's their main customer base. So even the price reporters that are relatively unbiased are starting to say, we're going to have a problem here if you don't start procuring at higher prices with these producers that need to build new mines. You have to do it. You have to do it soon. In the meantime, expect higher prices, and financialization to a greater extent could happen at any time.
Do you think the actions of Cameco and Kazakhstan, sort of what we spoke about earlier, and then you're talking about sort of reports and sort of people are giving the utility companies hints here that obviously this needs to happen. Are you starting to hear at all anywhere that utilities are finally starting to get it? That you were saying that they're looking at some of these priorities as vengeful. Is that sentiment starting to switch to understanding?
Yes, I would say that it's starting to. I would say this is like inning one of utilities coming around to the reality of the future price environment for this industry. But the fact that it's happening at all is a very good sign, and that's something new to see multiple utilities actually kind of coming together and attempting to communicate on behalf of the market, saying we've got a problem here if you don't step up. That's new. That has not happened before, to my understanding, at least as long as I've been following this market.
So obviously a lot of these, especially on the junior developer side, you even talk to companies like Cameco where they're all talking about these long-term contracts before they're going to make any CapEx decisions. One of the outliers there was a company, NextGen, that had a quick chat with at the show on the sidelines, and they were essentially saying that they were going to push ahead and base all the contracts on spot. They're basing their CapEx on a 2021 study. Do you think they can get away with it because it is such a good deposit, or are they realistically going to have to look at these long-term contracts as well?
NextGen holds a lot of power and influence right now with ownership of this asset, especially having to do with the numbers that have been put out by their feasibility study and their mine plan that the industry believes, right? So they've basically said that they'll be producing, they'll have a 48-month timeline. Permitting, if everything goes smoothly in the next 6 to 8 months, they should have a permit by the middle of next year. 48 months after that is mid-2030. Everything goes perfectly smoothly. First cake in a can, 2031 with ramp up. So let's say everything goes perfectly smoothly according to their plan. They'll be producing 29 million pounds a year in 2032 for the first 5 years, right? Now, most industry speculators believe that they tried to pull the most amount of value as possible into the beginning of production and really pump up that NPV in order to attract suitors. That's what a lot of people believe. And maybe that's possible, maybe it's not. But let's just say they don't have a suitor and NextGen moves forward with building this mine. Best case scenario, we've got first cake in a can 2031, which is already 2 years later than what the market believed a year ago. Wow. So and of course, we're talking about the largest mine and mill, largest uranium mine and mill ever built. So will that happen on time, on budget? Historically speaking, no. Now, does anybody have a crystal ball? Of course not. But mines are hard. Uranium mines are really hard. Any disruption to the timeline of development of this asset is going to have impacts on this market. Whether or not they have a suitor, we can't really say. We don't really know. That's what everybody was talking about. But NextGen does have the ability to demand the contract terms that they want. And the contract terms that they've signed thus far have been market referenced, right? And with high ceilings, very high ceilings and decently high floors. So yeah, they have a lot of flexibility in how they want to sell their uranium eventually. But they also have an enormous amount of influence. If they voluntarily, let's say they get into production, nobody comes after them in the next year, they start building the mine Q3 of next year. If at any point they say, this is going slower than expected, or we've decided to kind of spread out the capex of this project and build a smaller mill so that we can actually produce more uranium for a longer period of time rather than trying to produce an enormous amount in the first 5 years and then having a drop off substantially. Instead of doing 29 million pounds a year for the first 5, we're going to cut that in half. We're going to do 15 million pounds. We're going to build the mill capacity to 15 million pounds. And that, I mean, and they could absolutely do that. They can change their mine plan. They can change their feasibility once they start getting into this. So all of these things are possible. Nobody knows exactly how it's going to happen, but they do have a lot of influence and a lot of power right now, not only over utilities, but over the industry, over the price of uranium. And whoever owns that asset, ultimately, is going to wield an enormous amount of power. So Cameco is under a lot of pressure from shareholders right now to take them out. Makes a lot of sense on a lot of fronts. They continue to say they don't need it or don't want it. We'll see. We'll see how it goes, but it's a very, very kind of interesting and exciting story for sure.
Yeah, I was actually just about to ask you, obviously they get their permit, say next summer. How long do you think it will take for them to get taken out after that? It seems like the obvious M&A target for a couple of companies actually in mind. Do you think there's an appetite there for M&A? I guess it all depends on these long-term contracts, right? If the market's looking like the producers are looking like they're going to get what they want, they can be a bit more confident to spend the money on M&A.
Yeah, I think, a big consideration for a company like Cameco, because they're public, is, the ratio of their stock to the stock of the company that they would, the to-be takeout, right? So if they believe, let's say, which is something that they have mentioned in the past, if they believe that NextGen does attempt to build the mine themselves and they run into some hurdles, meanwhile, let's say the Cameco stock continues to be strong, if that ratio gets even better and better, then it's a better takeout for them or their shareholders at a later date. That's of course potentially a dangerous bet, because if NextGen does end up doing this and they are able to accomplish it, and Cameco doesn't go after this asset, do they have pipeline risks? Cameco lesser so. Orano definitely. Orano, I think, is in a I don't want to say a stronger position, but more of a position of need, because they've been kicked out of Niger. Cigar Lake is done in 2035. They're attempting to build an asset in Mongolia, and I do think that will be a mine in Mongolia, but the likelihood of pounds going west from there is very low. It sits between China and Russia. I mean, you can see the writing on the wall there.
Yeah, you'd have to fly out, I'd imagine, if you wasn't gonna. You can't really fly anywhere.
Yeah. So they're trying to ramp at Katco in Kazakhstan. They've got some JVs and some offtakes in Uzbekistan, but it sounds to us like those aren't going quite as well as expected. So they're going to have a pipeline problem, especially if you consider potentially influence from EDF, which is operating all these nuclear reactors, also state-owned, French. And a lot of they're building reactors in the UK. They're potentially going to build new reactors in France. A lot of life extensions look like they're going to happen in France. So they definitely need to add to their pipeline. And of course, they're a JV partner with Cameco in multiple projects. So that seems like the most likely, but it's really, really hard to say. When would a takeout bid happen is even harder to say. Like I said, Cameco might want to wait for them to attempt to build it themselves first, but who knows? I think if the first hearing goes well, second hearing goes well, I mean, a bid could happen sooner than later. mainly because I do think there's risk to some of the 2B suitors if NextGen just starts doing it and they end up being, who knows, 15 years from now, could they be a bigger company than Cameco? It's entirely possible.
Well, yeah, because if the price is conducive and they do enter production and they do front end a lot of this production, Jesus, the amount of cash flow these guys are going to have,
Yes.
it's going to be quite hard to take them out after that point, I'd imagine. You mentioned earlier that you do expect $150 uranium at some point. Could I push you on a timeline or sort of how you see this all playing out over the next sort of year or two and how you see the price adapting?
Sure. Again, no crystal ball and price predictions are notoriously difficult.
Yep.
I expect the next leg of this market to push higher than the previous, but I don't necessarily know that this leg is going to be the ultimate leg that takes the market to a very, very high price that sustains. So we could see one more iteration of higher highs, higher lows. So I think that's highly, highly likely that in the next, let's say, 12 to maybe 18 months, over that period of time, we go from where we are up to something higher than 106. So I think 120 to 130 is probably a decent target for that move. But there's so many other potential disruptions during that period of time. I mean, we'll probably have a NextGen / Aero based disruption over that period of time. Like something is going to shake up with that, whether it's the development timeline, whether it's a takeout bid. I don't know what it's going to be, but something is going to happen with this asset, for better or for worse, in the next 18 months. Something that is going to be market influencing. So that could have an impact on price. So yeah, I think what I expect is another higher high, higher low leg, followed by a period of consolidation, possibly similar to what we've seen, but probably more short-lived and still with some underlying upward price pressure, because the levers that the utilities have been able to pull over the past 18 months that has led to this consolidation, that has resulted in this consolidation, I should say, those levers are going away. So the next time we have that consolidation, the ability to flex up, the ability to buy in spot, the ability to buy UP, not to mention Russian deliveries by that time are going to be very, very close to being cut off to the US, January in 2028. So all of the things that have allowed for these consolidation periods are slowly dwindling and going to be unavailable at a future date to utilities. So higher high, higher low. This is my crystal ball. I think we see a higher, a 120 plus in the next 12 to 18 months. And a move from here to there is going to be very fun for equities investors. From there, it really depends on what we see in terms of contracting volumes and or supply disruptions. So it's really hard to say whether we stick around that price and just grind higher and stay sustained higher for longer, which is what the industry needs. I mean, if we went to 120 tomorrow, as long as it stayed there for 2, 3, 4 years, then we're going to see the supply respond.
Yeah.
And that's what the industry needs. But obviously, the utilities aren't paying attention to what the industry needs. They're paying attention to their own individual bottom lines. Can't really blame them for it. Trying to procure what they can at the best price they can for as long as they can. That's how everybody would operate, really.
Yeah.
But they're going to have a stark reality that they're going to be facing on a 5 to 6 year time frame. And unfortunately for them, that's the period that they're going to be trying to cover now. You go out into the early 2030s and the coverage rates are very, very low, extremely low in the United States. I mean, they're basically uncovered in 2032, 33, basically across the board in the US. The EU is a little bit better covered, but most of the world is uncovered early 2030s. So yeah, should be interesting.
And Justin, just so people are aware of sort of who you are and what you do and where to find you, what I know you do webinars, you host your own channel, I think you've got a newsletter as well. Just a little bit on, obviously, I'd imagine most people listening to this, if they are into uranium and they're not following you already, probably want to. So how do they go about doing it?
Sure, yeah. I mean, uraniuminsider.com is our website. We've been covering this sector since 2019, and we have a very deep network in the industry. We put a lot of focus on the fuel cycle. So especially the price of uranium, who's trading it, at what price, what does the contracting market look like? We do a special uranium market report as well And this is our primary focus because if you're invested in a commodity, you need to know what the heck is happening with that commodity. First and foremost, the influences on the equities, of course, matters a lot, especially in the near term. But we want to be right directionally about the price of the commodity more than anything. So that's our primary focus. That's something we communicate to our membership on a daily basis. We have a trading model. We have a focus list portfolio that's more of a buy and hold, fundamentally driven. Then we have a trading portfolio. The trading portfolio is up close to 60% this year, and that's doing extremely well. So that is something that between the physical market focus, the trading portfolio, the focus list portfolio, we do monthly webinars for members only. I'll do a video update just about every week. We do daily updates and communications on the SPUT data, the ETF data, what's happening in the market on a daily basis is communicated to our membership. So we've been focused on this for a very long time, and we actually it's surprising to say this because the newsletter's been going since 2019. I've been following this market since 2016. I can't believe I'm saying this, but I actually feel like there's a decent runway here. I don't see where the supply that's going to stem the tide of this rising price trend is going to come from. I just don't see where or when that's going to happen. So I think we have many, many years ahead of us, and it's going to be, I think, a rip-roaring, robust bull market for the commodity.
Nice. Yeah, I think you might be right. And daily updates, it sounds like you're a pretty busy man. So I do really appreciate you coming on and taking the time to share your thoughts with us.
It's an absolute pleasure. Thanks again for having me on.